section as well as our tech analysts, where we'll be also highlighting some of our few overweight sectors after the market strategy. I guess that to actually set the tone for the second quarter, overall, we reiterate our positive view on the market. I think on the macro front, the global interest rate cycle are likely to have peaked. Likelihood of a Fed's cutting rates in the second half this year, and the recent strong macro data pointing towards a recovery. So all these are likely to see a more positive market as well as on the macro front. And of course, if you look at year to date, Malaysia has definitely been one of the better performing market within the Asia region. Okay, basically, if you look at the first quarter, just a bit of a recap. Malaysia continues to see ringgit weakening against the dollar. If you look in terms of the regional currency as well, it has also weakened. So it's definitely not something that is only happening in Malaysia. But the culprit of a weaker ringgit has been largely due to a few factors. I think number one is the 2023 GDP expectation actually came in weaker at about 3.7%. And on top of that, on the macro side, the global market were already expecting a quicker interest rate cut, but has since expect this timeline to be pushed back, which has been supporting the stronger dollar. I think that if I'm not mistaken, market actually started out with about more than 5 cuts, and it's only now down to about 3. And with the recent Israel-Iran tension, market could possibly further push back this expectation in terms of timeline on the fear of a heightened inflation. But all that being said, we do expect ringgit to actually be better in the second half. Again, if you look in terms of the global semiconductor sales, it has been showing a good recovery momentum. The global E&E sales recovery is a bellwether of the Malaysia E&E export improvement in the coming days. On top of that, if you look in terms of the government economic reform, the NETR, the National Industrial Master Plan 2030, 12 MP, all those are basically positive initiative for Malaysia, and government higher DE spending for investment to actually stimulate the economy by reviving some of the key projects that were likely to support the local ringgit as well. I think that this is not something new. Malaysia has always benefited strongly in terms of the FDI inflows, which is what we can see on the left, especially on the manufacturing front last year. On the right, basically, you will see that in terms of the recovery, in terms of the tourism sector, continue to show a positive sign. The air passenger traffic volume is improving and likely on track. So we do believe that a combination of all these factors will likely drive a stronger ringgit despite the 3% weakness that we have saw in the first quarter. I think that one of the other thing that investors should also have take a look is the 10-year US Treasury yield, as this also helps to predict the ringgit movement. As you can see here, as yield reduce, ringgit tend to strengthen in tandem. And we are expecting ringgit to actually be one of the better performing currency this year, reversing last year losses on the back of the government domestic reform agenda on both the economy as well as the fiscal front. So for this year, we are expecting ringgit to strengthen towards the 440 as well as the 450 region from the current 470, 480. Again, this is just a repetitive of what I touched on earlier on. Basically, we do expect to see inflation has already peaked, and likely the Fed funds rate will gradually reduce in the second half. This is just a quick summary of what we'll be running through for the Malaysian market strategy. As usual, a quick market recap, second quarter outlook, as well as where our strategy lies. If you look at the chart on the left, first quarter is definitely off to a very good start, which actually saw global market continue to trend higher. As mentioned, this is partly due to market actually scaling back on the rate cut expectation following the surprising stronger economic data. As such, market sentiment was overall better. US large cap, as you can see, continue to outshine, driven by a more broad-based sector performance. Within the developed market, Japan, which did very well, which did very well last year, continue to top the chart in the first quarter this year. I think that again, this is due to a combination of factors: better corporate growth, the regulatory and corporate governance reform effort has starting to take place, as well as the weakening in terms of the yen. Taiwan, no surprise, continue to see a strong investor interest, especially in the semiconductor front, due to the AI excitement. But it's not too bad for our local market. KLCI is one of the top performing market in Asia. Like I mentioned, KLCI is up about 6%. Small cap actually performing slightly better compared to the CI. So that overall, that actually put us right about in the middle compared to the other regional markets. In terms of the sector and stock performance, as you can see here, utility sector continue to be the best performing sector, thanks to YTL, which was up by YTL Power, my apologies, which was up by about 50% year to date. Tenaga, I think, is up in the teens. If you look in terms across the other sectors, the energy, property, construction are also among some of the sectors that has done well. And of course, in line with the decent KLCI performance, I think that on the top right, at the bottom right chart, you can see that most of the top 30 CI components actually shows a positive return, excluding the likes of your PETDEC, your public bank, Petronas Chemical, Maxis, and the likes. Okay, so this table here basically shows you the foreign equity fund flow of the Asia 6 market and Malaysia. As you can see here, focus on the second as well as the third column from the right. So basically that actually shows you the Asia 6 as well as the Malaysia inflow or outflow. So basically for the first 2 months for 2024, Malaysia saw a foreign money inflow in the range of 100 to 200 million US dollar. But that quickly reversed in the month of March, whereby we saw a greater reversal of about 600 million US dollar. But on the contrary, the Asia 6, that's you can see that on the dark blue row. You can see that Asia 6 actually saw about 18 billion of equity inflow, mostly into Korea, mostly into Taiwan, driven by the continuous interest into AI and tech-related stocks. So basically, this is basically just a repetitive as well as a summary of what I mentioned. As you can see on the bottom right-hand column, you can see that our foreign shareholding for the Malaysia equity market has bottomed for now, and it's now hovering at about 20% region. Okay, I think that from here on, we will start moving into our second quarter outlook. Basically, over the next few slides, we actually highlighted a few themes which we think that investors should actually take a very close look in the second quarter as well as the second half. I think firstly is on the FDI, your foreign direct investment, as well as the trade diversion theme. I think there is no surprises that Malaysia has attracted a huge amount of FDI, and even more so during this uncertain time when US and China is having a lot of conflict, that actually resulted in the geopolitical tension. And as a result, this has led to a lot of MNCs actually diversifying their supply chain out of China under the China Plus One strategy. So basically, I think I'll not go through on who is the beneficiary because that is something that I'll touch on later on. So that's theme number one. I think that similar here, basically, I think that when it comes to the FDIs, more often than not, it's just centered around the Penang as well as the Johor. I think that Penang, as all of you know, is basically on the tech side, and Johor is likely on the property as well as data centers. So I think that I think that for the Penang, we will continue to focus on the Malaysia techs. Also some of the industrial park developers, as well as the MEP providers, which actually focus on the semicon as well as data centers, as well as the industrial EMS players. So Johor team, I think, is pretty well known here. We expect news flow to remain positive and likely to see more development to come. Team number three is on the data center team, again, which is largely centered around the Klang Valley and Johor. I think that there is a lot of investment pouring into this space, and we do believe that there will be more to come. On team number four, we would actually like to highlight on the renewable and solar team, with Malaysia aiming to actually scale up the RE to about 70% of the installed capacity for its overall power mix. We do believe that there are a lot of solar PV capacity gaps that actually need to be filled in order to achieve this long-term target. As such, we expect a lot more RE assets tenders to be rolled out. I think that if you listen to my analysts, I think that we estimate about 3 billion worth of contracts to be rolled out by this year relating to CGPP, and with LSS happening likely to happen next year. I think that could add another about 7 billion. So overall, we are looking at around the region of about 10 billion worth of tenders to be rolled out. Lastly, is on the oil and gas. I think that global oil price is looking strong at about $90 per barrel. I think that over the past few days, some of you might have heard about the tension between Israel and Iran. So we do believe that near-term oil price will be supported by this uncertainty. But nevertheless, closer back home, if you look in terms of the activity outlook guided by our national oil company, Petronas, is actually looking positive this year as well. And alongside the higher capex, we think that this will be a very good year for the oil and gas. But we believe that there should only be a handful of segments where investors should actually focus on. Basically, that's on the hookah commissioning, the OSV, the plant and abandonment side, to name a few. So that's the five teams that we highlighted. In terms of these two charts, basically these two charts just shows you that market tends to have a direct correlation to the ringgit. And with the expectation of a stronger ringgit, market should actually remain quite positive for the remaining part of the year. If you look at the global market valuation, I will say that it's not too attractive or too appealing in terms of the valuation. S&P on the left, Nasdaq on the right. You can see that both is actually trading above its mean. And knowing that valuation is not too attractive, some of you might ask, what are the expectations of the US market this year? As you can see, with the scaling back of the interest rates, market has generally done very well. But I think that all eyes will be on the US election, which is taking place in November this year. We do expect some degree of volatility. But as you can see at the bottom table, based on our analysis over the past 6 elections, I think that US market tend to return positive in the 12 months leading up to the elections. And with just slightly over 6 months to go, we do believe that market sentiment will likely be relatively positive. And why? How does this matter to the Malaysian market? Is, I think, not surprised to everyone. Generally, when US or the regional market sneeze, as again you can see the US, the Iran-Israel tension. Last Friday we saw that the regional US market was down by about 1 or 2%. Malaysian market tend to catch a cold like we saw this morning. So in that sense, we can expect a lesser market volatility being influenced by the US market. Basically, historically, as you can see here, the small cap has constantly outperformed the KLCI due to the cheaper valuation. I think that earnings profile has been a lot stronger than the large cap. If you look at over the past 10 years, small cap return positive out of 6 out of the 10 years, whereas your CI only returned 2. And a lot of people has been asking me, saying that domestic market valuation is looking cheap. If you look in terms of from a PE perspective, on the graph on the top, it's only trading at about -1 standard deviation. It's a 10-year mean since 2021. But with consensus expecting about 14% KLCI EPS growth and trading at about 14 times forward, market is definitely looking quite appealing. But we do believe that cheap can always stay cheap for a period of time, right? As you guys know, our CI it's pretty much dominated by the traditional economy, and some of it is being dominated by the plantation sector. So there are a lot of ESG factor that everyone should actually consider, which might actually depress the market valuation for a bit longer. So on that note, we much prefer to be in the small mid-cap space, where we actually see more values and higher alpha. Okay, so I think that the following 3 slides are probably the most important slide in the whole deck. So something that you guys might want to pay a bit more attention. I think that moving into 2024, this is how we like to position the market. We are overweight in 8 sectors: the construction, the EMS, the healthcare, the industrial, oil and gas, the renewables, the rubber glove, as well as tech. So how we actually categorize industrial is basically the MEP providers, the mechanical, electrical, as well as process utilities providers, which actually serve the semicon as well as data centers sector. and we are overall just new, and we are just neutral on one sector. Basically, that's our property. And below the table below is basically our top 10 buys in the Malaysia within Malaysia, arranged by upside. As you can see, it's basically across the sector, combination of a circular growth trends as well as a lot of corporate recovery. Basically, for instance, Cape EMS is an industrial EMS player. UMedic is healthcare. Pentec is oil and gas. UWC Penta is tech. Gamuda is construction. NationGate is another industrial EMS player. Dayang Oil and Gas, Optimax Healthcare, and Kerjaya being another construction play. And in these slides, basically, this is some of our thematic buy calls. Basically, highlighting the structural growth themes that investors should not miss. As you can see, it's a combination from FDI beneficiary to the AI data centers to the Johor place. So basically, I think some of these names are overlap within the respective categorization, because they actually kind of in between FDIs as well as AI data centers, for instance. I think that it is also very timely. We actually initiated on another industrial name just this morning, in time for the second quarter outlook. I think that within the AI data centers, I think that we recently initiated on critical as well as a HE group. So these two actually serve the semicon as well as the data center space. So I think apart from the three thematics, I think that in these slides is basically highlighting the news flow driven construction, the electric vehicles, as well as some of the earnings recovery, whereby we highlight some oil and gas names, as well as a glove, right? So basically, this is our expectation of the KLCI next rebalancing in June. Basically, as you can see, the name highlighted in orange. Basically, we see the possibility of Sunway being included into the CI in June. So I think that to sum it up, despite the strong market performance, we still see room for market to actually grow further. I think overall we are still relatively optimistic on the market. I think that the market weakness, like what we saw this morning, due to the Israel-Iran conflict, is an opportunity for investors to actually accumulate. And we highlighted our top 10 buys and some of the thematic buy calls that we think that investors should actually not miss out on. I think that no changes in terms of our KLCI target at 1590. I think that for the ringgit front, we are expecting it to strengthen, like I mentioned earlier, towards the 440, 450 from the current level. And of course, we do think that the Brent global oil price will likely stay elevated at this current level. Okay, so I will stop here for now and allow my colleagues to take over from here. I think that for today, we will be highlighting on three sectors. We will start by construction, moving on to industrial, as well as tech. I'll pass on to our colleague on the construction and industrial. Kejun, thanks.
Hi, good afternoon, everyone. So I'll start off with my construction sector overview. So basically for construction side, we are expecting infra projects to roll out, which is backed by the government's commitment to allocate at least 90 billion for development from 2023 all the way to 2025. This is quite an increase from the original 80 billion. And then but then it's likely that the infra projects that we see rolling out in the coming months would most likely be infra projects outside of Klang Valley, such as Penang, Sabah and Sarawak, Johor, to roll out first. Because as some of the arguments have always been that the infra budget have been too concentrated within Klang Valley previously. So it's likely that the government will put more emphasis on other states first in the coming few months. With that, based on our channel checks with some of the construction companies, it's likely that MRT3 tender award will be deferred to 2025. But then, as I mentioned, the infra projects throughout would likely be focused in other states as well. So at the meantime, Penang RT just received green light from the government in March, so that basically now the Penang RT is a go. But then in terms of the project cost, all this, the MRT Corp and SRS Consortium, which is 60% owned by Gamuda, is currently in a negotiation on the to finalize the project cost, and it's expected to complete in 6 months. And then besides that, some other infra projects that we should look out for would be the Penang International Airport, Pan Borneo Highway at Sabah, and also Johor LRT. But this is still very preliminary, so we should look out for the news flow for the following news flow. And then in terms of the data center investments, it's also providing an opportunity for quite a lot of contractors to replenish the order book. And basically, the data center investments in Malaysia are expected to remain robust. And basically, for construction, for this team, the beneficiary would be contractors with infrastructure and DC track record. And our topics for the sector would be Gamuda and Kejaya Prospect. Next one. Okay, so I'll go a little bit more into details for Penang RT since it's recently approved. So as for the alignment, for the first segment, it's likely to be, as shown in the photo, whereby it's expected to have 23 stations along Komta all the way to Silicon Island A, which basically is an island that is currently being reclaimed by Gamuda. And then overall, although the project cost is still in negotiation, we are expecting the construction works to be in the range of 7 to 8 billion. And then we are expecting the works to commence in second half 2024. And moving forward, we expect the open tender for the second and third segments to eventually come in the next few years to basically complete this whole Penang RT system, whereby basically the second segment is expected to link Penang Island to the mainland. And then the third segment is basically the turnkey contract for the systems and trains. Overall, we expect Gamuda to take charge of the construction due to its project delivery partner role, while it's also likely that some of the works will be subdivided into smaller packages to share with other contractors. In terms of potential beneficiaries, some of the contractors that are expected to bid for the packages include Suncon, IGM, and MRCB. And the next slide. Basically, we reiterate our overweight call on the construction sector as we anticipate our coverage to benefit from the rollout of these mega infrastructure projects, the influx of data center investments, and also some the consistent contracts from the resilient property market. And then top sector buys are still Gamuda and Kejaya, given the strong position that they hold in the respective construction subsectors of infra, building construction. And then both are trading at an undemanding 12 times forward PE. Besides that, we also have a buy call on AME Elite, which basically we see them as a unique exposure for investors to capture the influx of FDIs. As you know, AME Elite is actively developing industrial parks at FDI hotspots such as Johor and Penang. Okay, next slide. I think one slide back. Yep. Okay. Yeah. For Gamuda, basically our TP is at 655, and then we like Gamuda's for its regional exposure for both construction and also property. And then basically Gamuda is well positioned to benefit from the rollout of Penang RT contracts, as I mentioned just now. And besides that, the group is also, actively getting infrastructure jobs in Australia, Taiwan, and Singapore as well. So they are not solely reliant on the Malaysia infrastructure projects. So that's one of the key things that set them apart from the peers as well. And then Gamuda also recently expressed optimism in securing at least 2 data center projects in this financial year, while they are expecting to maintain similar contract win momentum, which basically they are expecting to win 2 data center jobs every year in the data center space. And with that, we believe Gamuda's current valuation of 12 times forward PE seems very attractive. Our target price is pegged to 18 times construction profit and also the INEV of its property site. Okay, next. Okay, for Kerjaya prospect, we like the consistency in delivering above average PAT margin of 10% versus industry average of 5 to 8%. And then basically Kerjaya has been consistently securing high-rise construction jobs from reputable clients such as Gamuda and UM Sunrise. And also they are kind of like a good proxy to benefit from one of its related party companies, Eastern E&O, who is basically developing an reclaimed island at the northern side of Penang, which is called Andaman Island. And that island basically gives E&O basically 20 over billion GDV that will be gradually unlocked in the next 15 years. And Kerjaya has been the go-to contractor for this development. So with that, you can basically expect very consistent contracts coming into Kerjaya as E&O develop this 20 billion island in the next 15 years. And then other than that, they also have a joint venture with Samsung. This basically opens up opportunities for the group to venture into design and build contract for some of the advanced production facilities job. One of this ongoing one is the Texas Instrument Factory in Malacca. Valuation seems attractive, 12 times trading at 12 times for PE. For the target price, we are setting at about 16 times. Next, for industrial, yes, as mentioned by JY just now, for our industrial side, we basically like this MEP engineering providers. And then for them, they basically benefit from two teams, basically the data center team and also the FDI team. So I'll briefly go into the data center landscape in Malaysia. So for Malaysia, we have attracted more than 76 billion worth of data center investments, and this is attributable to the favorable conditions such as welcoming government policies, the availability of land and power, and also which results in basically relatively low average cost for these data center operators to set up the data centers in Malaysia. As I quote one of the independent research, where basically Malaysia DC average cost is estimated at about $10 per watt, lower than some of our ASEAN peers such as Singapore and Jakarta. And this has basically attracted several major DC operators such as AirTrunk, GDS, Zellowwood to set up their data centers in Malaysia. And basically they have secured more than 1,500 megawatt for their Johor-based data centers. This basically means that they secured the electricity supply for all these data centers. And then additionally, they are expected to establish another there are expected to be more data center facilities that would be coming in with another 2,000 megawatt demand for power. And with this, we estimate this 2,000 megawatt to potentially generate additional investments of 94 billion ringgit, assuming average cost of $10 per watt. And next. And then, as I mentioned, we like the MEP solution providers as they are well positioned to benefit from the growth of all these structural growth, the end users, where it includes semiconductor, data center, telecommunication, and solar. Overall, the industry grew about 15% throughout the past few years. And then basically the increasing demand for MEP and engineering will be driven by the growth of its end users, as I mentioned, and then as they correlate with the higher domestic and foreign investments, and also the trade diversion play, and also basically they are expected to benefit from the growth prospects of the semiconductor or E&E ecosystem in Penang also. And yep. And with all that, we see these MEP players as a proxy of rising FDIs, given the exposure in semiconductor and data center. Our sector top picks are Critical and HE Group. And then for Critical, they are basically set to capitalize on the semiconductor sector recovery, as I mentioned just now, and also the enormous DC investment opportunities in Malaysia. And basically with that, the order book replenishment prospects is likely to be positive, backed by its sizable 1.2 billion tender book, which has doubled in the past few months. And then Critical's ROE stands out above average at 69%, while it sits on a strong balance sheet with 49 million net cash position. And then this HE Group is our newly initiated. We just initiated HE Group this morning. So basically, HE Group is a electrical engineering service provider. They're predominantly the electrical engineering service provider, but they stand as a strong beneficiary of FDI with a high exposure of their revenue, 70 to 80% coming from semiconductor and E&E end users. And besides that, the HE Group is also expanding their footprint into data center space through a partnership with Vertiv. And basically, we're expecting them to secure some data center jobs moving forward. HE Group's net is standing at a net cash position of 50 over million or so. This provides ample of room for the group to grow and expand its capabilities, potentially via M&A, and eventually become an integrated MEP solution provider. As I mentioned just now, they're currently more on the electrical side, which is the E of the MEP solution. So eventually they will acquire more capabilities for the M and P capabilities also. Overall, we're expecting a 3-year profit figure of 50%, trading at 12 times forward PE, attractive. Our target price is pegged to 18 times. And then now I'll pass on to my colleague, Lucas, for the tech sector.
Thanks, Cajun. So yeah, right now I'd like to share with everyone our findings and the view of the overall tech sector. So just like I mentioned last time, after going through a slowdown last year, we continue to see a recovery to take place in the second half of this year. And our views are still pretty much in line with market intelligence such as the WSTS, SEMI, and etc. As they each of them forecast a recovery between 10 to 20% from the contraction in 2023. So we see the tech sector experiencing a growing demand for new and advanced technologies such as the AI and smaller NM chip. So we believe this will drive the demand, especially in the memory segment, as higher bandwidth memory, or for short HBM, is required to run and support these processing capabilities of these AI chips. And this segment is forecasted to grow about 40% year on year, while other segments are also poised for an uptrend, with the US and APAC regions leading the growth. So some of the recent updates that we can find reported by SEMI is like during the year-end period of last year, sales of for electronics and ICs, this shows an improvement, and cited that also demand has recovered as well as inventory levels have started to normalize. So and these sales are projected to continue this momentum for 2024. But for capex and fab utilization rates will start the year with a mild recovery after the declines in second half last year. Similarly, equipment billings were also above expectations in the end of last year and was foreseen to have about a muted growth in the first half due to seasonality reasons, but still remain an overall growth throughout 2024. Next slide, please. Just like I mentioned earlier, the global sales, semiconductor sales are projected to grow, and SIA and IDC forecast like a 30 and 20% growth respectively, with global PC and smartphone shipments signals improvement in demand after suffering from economic challenges as well as high inventory. So some updates on that. Overall, we are seeing slow and steady improvements in these two segments. The global smartphone shipments declined in overall in 2023, but it has seen better than expected performance in the second half last year. They showed a 9% year-on-year growth during the last quarter. And for the global PC shipments, has also surpassed expectations slightly in fourth quarter last year, which indicates a solid recovery trend to be paid for 2024. You can see that in the bottom right chart there. You see like during the end of last year, there's an uptick from a downward trend throughout 2022 and 2023. Yeah. So we see these improvements to be driven by new and emerging technologies, like I mentioned earlier, like an AI, which is expected to pave this sector renewed our growth trend, further backed by the dissipation of inventory levels. And this also can be supported by comments such as TSMC, a key foundry player for major global fabless companies, where they express like optimism for a more robust growth for this year, taking into account of their customers' depleting inventory in the PC, smartphone, and the automotive segments, as well as Suncor. Suncor is one of the largest silicon wafer producers in the market, in the world, sorry. They see like market bottoming out in the fourth quarter last year, as well as this coming first quarter 24. And they don't expect any further market condition to deteriorate. And overall, they state that, first half will still be a bit tough, while expecting a stronger rebound in second half. And in the test space, similarly, they see improvement for this year due to their newer 3nm technology in the mobility space, as well as the PC smartphone market. And geopolitics-wise, will still put the Malaysian tech sector in line with what JY has presented regarding the trade diversion play. Hence, this Malaysia will be in a favorable position to driving inflow of FDI into the region, while MNCs seek for alternative location and suppliers through initiatives that you may have heard online as in the news, such as Taiwan Plus One and China Plus One. Yeah. And this can be this is evident, as you can see, like recent news announcements by made by leading wafer equipment makers like Research or even Micron, which is a memory player, or investing a big amount of money into Penang and over the next few years as well. So with this expansion plans, we can see Malaysia's importance in this semiconductor supply chain, especially in the midst of this geopolitical tension. Next slide, please. So overall, we like to maintain our overweight call on the tech sector, as we anticipate our coverages to benefit from this inflows of FDI, as tensions rise between US and China, as well as and also the growing popularity for AI-powered devices and electronic vehicles. So we advocate investors to start looking into strong secular trends such as automotive, data centers, medical tech, and 5G. But the anticipated ringgit strength may dampen earnings because many of our local tech companies do their business in USD. And also with the global inflation coupled with the US Fed fund rates, reducing the interest in this year, should see investors shifting back into these growth names. Our top picks for this sector are UWC and Pantamaster, as they hold in the respective front and back end, as well as automotive exposures towards this trade diversification. And if you're looking for a unique exposure to AI and EV, we see Franken and Greatech as key beneficiaries for these new and advanced technologies that have been released or are yet to be unveiled to the market. Next slide, please. So touching a bit on UWC. So UWC is strategically positioned to benefit from its move into the front-end semiconductor market on the back of recovery in this global foundry capital spending that we have mentioned before. We have a target price of 368 cents. So what UWC does is they turn big metal components into small components, using like milling machines, CNC, and they assemble these parts into finished and semi-finished products. So overall, we like UWC's move into this lucrative front-end market that delivers higher margin and profits. So what is front end? As many of you might not know. So basically, front end is basically like the initial stages of creating these chips that you see that is in your phones and in your laptops. And this is where like the raw materials, like what some call create from the silicon wafers, undergo like a series of processes to form like the structures of the chip. And you can think of it as laying the foundation and constructing the framework of a building. Yeah. So, and the front end addressable market is 6 to 7 times larger than the back end addressable market, which makes it more lucrative for UWC that is tapping into it right now. So UWC is moving to serve customers in this front end semiconductor market, and they also stand to benefit from these MNCs, diversifying out of China, and investing in Malaysia. Next slide, please. Next slide, please. And for Pentamaster, they are set to capitalize on the emerging, SiC or silicon carbide and the automation solutions, brought by the overall EV demand trend. We have a target price for 565 cents, and Pentamaster produces automation equipment for the semicon and EV players, such as testers to test the chips at the wafer level or the package level before they go into the final assembly of the full products. So we like Pentamaster's specialization in IGBT and SiC assembly and test solutions. So maybe a bit quick a description of what is IGBT. So IGBT is basically a very important electronic component, which is used in many applications, as well, particularly in power electronics. So who uses a lot of power electronics? Basically EVs. But they're also used in other industries such as solar and home appliances. As for silicon carbide, it's actually a material blend of silicon and also carbide. And this is silicon. You can see silicon carbide is like an upgrade of the traditional silicon chip that's used in power devices. And it's an upgrade because of its superior electrical field strength, larger band gap, and also reduced power loss, better durability, basically a lot of things better. Yeah, and hence positioning it as a future of a power device tech. So the advantages of this SiC technology is becoming more and more notable at the higher voltages required for EV batteries. So, and this is anticipated to dominate the production of future EVs. Yeah. So another growth factor for Pentamaster would come from them expanding into the manufacturing facility for medical automation, as the business diversification over its heavy reliance on the automotive segment. So yeah, getting more and more customers in this segment and also to diversify from this automotive segment. So both automotive and medical is seen to be a higher growth for Pentamaster. And of course, Pentamaster would stand to benefit from the US export sanctions to China. And that will be it for my sector presentation, and we'll dive into Q&A.
Yeah, okay. Thanks, Kejun. Thanks, Lucas. I think that since we have a couple more minutes, I think that probably I'll just run through a bit on the oil and gas sector. I think that again is timely to update on the sector considering the Israel and Iran tension. I think that overall, we do expect global oil price to remain supported, even so under this uncertain time. if you look in terms of the Petronas capex spending, I think that 300 billion over the next 5 years is looking quite encouraging. The global industrial capex is also expected to grow further. I think that if you look in terms of the Petronas activity outlook report, which is an annual report being updated by Petronas, I think that overall the activities are still looking quite rosy. So as such, this is why we actually have an overview on the sector. Basically, if you look across of our four buy calls, Dayang is actually in the Hoka commissioning as well as MCM segment. Pentec is one of the huge beneficiary of the FDIs, especially your Pengerang, your China FDIs. USMA is actually in the plant abandonment space, which is also a beneficiary of the Petronas activity outlook. And lastly is on Bumi Armada. I think that Bumi Armada is the only company which do not benefit from the Petronas activity outlook, being a global player. But that being said, I think that with again global industrial capex expected to increase, we do believe that will actually benefit Bumi Armada as well. So I mean, as you can see in the morning session, the oil and gas sector has done well, despite we have, I think, over 900 over losers that actually declined this morning, and we do believe that investors should definitely focus on this sector as well. And Pentec and Dayang is our top pick within the sector, but in terms of upside, it's actually USMA and Pentec. Okay, so that's on the oil and gas side. And we will stop here for some Q&A. But I think that for the time being, let me just bring you guys back to the thematic buy in case there's any questions relating to our thematics. Okay, I think throughout the presentations, we do focus on the ringgit. I think that although ringgit is looking relatively weak for the time being, but we do think that there will be certain sectors that will actually benefit from it. Of course, the oil and gas, which is actually billing in US dollar, the tech as well. So I think these two sector will definitely benefit in terms of the weaker ringgit. But that being said, just a refresher for those that might have missed, we are expecting a stronger ringgit in the second half towards the 440 and 450 from the current 470, 480. Okay, there's also a question on top three that is worth to explore. Okay, I think in terms of the top three within our top 10 buy universe is definitely this slides that investors should actually focus on. This is basically our country top picks, and by upside it's KIP EMS, UMedic, as well as Pentec. But again, if you look in terms of our thematic buys, across the different thematics, we have already arranged the companies by upside. So if you guys like, you guys can take a picture and see what thematics you guys are comfortable with and position accordingly. Yeah. Okay, questions on NationGate. NationGate is also one of our top 10 buys. Basically, I think being one of the industrial EMS company, I think that they are definitely going to benefit greatly from the FDI inflows. They are also in the AI data center teams, which are highlighted, which we have highlighted under the AI data center as well. I think that a lot of them will actually come into flotation towards later part of the year and possibly next year, latest. And if you look in terms of our EPS growth, I think the EPS growth is looking very decent for 2024 as well as 2025. But do note that valuation is slightly on the high side, right? It's trading at about 18 times forward 2025 PE. So if you are looking at some others, FDI beneficiaries or AI data center proxies, there are some other names that you might want to consider, which actually come with a cheaper, more attractive valuation. Okay, in terms of dividend, okay, I think in terms of dividend yield wise, I think that Pentec, I think that Pentec is maybe Pentec has about 6% yield. Kerjaya Prospect has close to about 5% yield, so something that you all might want to consider. 6% for Pentec, 5% for Kerjaya. I think that for the rest wise, Lagenta also has close to about 5% dividend yield. Yeah, I think pretty for the rest, pretty much is still quite low. But of course, based on my what I heard from my glove analysts, Kosan, I think that Kosan management is actually guiding that when the market demand dynamics actually recover, they are looking to pay off a one-off special dividend. So although that the Kosan dividend is about 0.9%, which is about 1%, I think that this has not factored in the one-off special dividend, which might be something that you want to consider as well. Okay, Top Glove. I think that we only like Hatarika and Kosan for the time being. I think that in terms of the cost structure, in terms of the net cash position, Top Glove is actually not that attractive. So hence, due to the ineffective cost structure, we do prefer the more efficient player, being Hatarika and Kosan. Okay, Black Swan event. Of course, the reason why it's called Black Swan is no one can really predict what's going on. But I think that market volatility is always there. But that being said, I think that if you were to stay invested in the market in the long term, I think that generally investors will definitely get a positive return from the market. So regardless whether there's any Black Swan event, we do recommend to position yourself in the structural growth teams, which actually have story for the next 3-5 years. And most importantly, there's a very clear earnings visibility. There's a very good story. Valuation is not too expensive. I think that all these criteria combined should actually weather investors through any unforeseen global events. Okay, I think that we have hit the 1 hour mark. Roshan, over back to you. Thanks.
All right, fantastic. Thanks again, JY,